Welcome to the Second Bite Podcast, where we talk with top entrepreneurs and CEOs about creating valuable companies through creative transactions. Now, let's get started with the show.
Hello, and welcome to the Second Bite Podcast. I'm Todd Taskey, your host. We are in question 2 of the PE Insight series. And in this episode, we're talking about deal killers. We're going to talk more about LOI in a future questions. Letter of intent. But for this topic, we're focused on what are the main deal killers. Once you've signed an LOI, why doesn't the deal get all the way to close? And we hear about these stories quite often. We have a lot of strategies during the LOI process before we sign an LOI to make sure that successfully moves all the way to close. That's our perspective. What I wanted to share with you is the perspective from the buyer side, which are very often private equity or private equity-backed companies. So in this episode, we talked to our 8 guests and asked them, in their experience, what's the number one thing that kills a deal that doesn't get to close? I think you'll see a lot of recurring themes here. So I hope you enjoyed this episode. Quick shout out to our friends at Fiscal Advocate. They're our sponsor for the podcast. Fiscal Advocate, if you don't know, helps agency owners get a real grasp on their financials, not just in a way to understand their financials, but in a way to manage their business. You can find their contact information on the show notes. You can also find them online at Fiscal Advocate. Enjoy this episode. Thanks. Bill Sommerschield from Keystone Equity. Question, you pass on a lot of deals because you see so many. Mm-hmm. But when you get a deal under LOI, what's the most common reason why that deal doesn't get to close in your experience?
Look, I'd say there's quantitative and qualitative. So sticking with the quantitative first, number one is probably people setting overly ambitious growth targets for the sake of trying to get a high bid and missing them dramatically. I think we all understand process is distracting. Not everything's going to go well all the time. Small misses here or there, or not winning a contract here, or not having a project materialize or an engagement materialize is fine. But, if you're setting something just to get somebody to sign a piece of paper, and then, ultimately as they dig in more and you show more months, you don't hit those targets, that's a tough one to overcome. For us, bad customer feedback is clearly the second, right? Either the loss of a key customer where there might be concentration around that customer. But look, we do dig into the relationships with those customers as much for what we can do with you as a business owner long-term to drive more value into that customer, to deliver more services to them, whatever it happens to be. But we're gonna get access to them at a later stage. And so if you've got a fragile customer base, that's going to get found out. And so, it's better to own that up front than just kick the can down the road there. Look, I think qualitatively it's for us, again, we as a firm, because we're the largest investor in our fund, our whole heritage is investing our own capital alongside entrepreneurs and working closely with them. That relationship is sacrosanct between us and the founder, entrepreneur, or management team we're backing, right? So no business is perfect. How people react to discussions around potential business improvements we might see, whether they're defensive about it, whether they own it or they can debate it, but kind of are open to other opinions, is really important. And you lose confidence when somebody doesn't understand that every business can be improved. And this is a marriage of some sort. It's a business marriage, right? And so getting that relationship piece right is absolutely critical to us. And so when we don't get the right, signals on how we're going to work collaboratively together, that becomes pretty tough for us. And I guess the last, which is a combination of, quantitative and qualitative, is really around data hygiene. And again, it's not tracking metrics, not being able to let us, really pull apart a business into the constituent pieces and understand the intricacies of it. And so, there's pre-work that needs to be done well before you go to market on some of that stuff. I'd say that's less of a reason a deal doesn't get through, but I think certainly is a value inhibitor as we get into some of your other questions. But I think those the growth, the customers, and and that partnership is the big pieces.
Bill Sommerschield, thanks for the insight. Nick Moritsugu from Imperial Capital.
Yeah.
Question is deal killers. So when you now have a signed LOI, a lot of sellers worry that the deal's not going to get to close or it's going to change substantially. In your experience, what causes a deal to not get to close or to break? What are the most common reasons for that?
Yeah, I think I would say two, right? I think the first is more about, expectations versus reality is how I would characterize it, right? And what do I mean by that? I mean, you have to be really thoughtful when you're bringing a business forward on, what number are you marketing it off of from an EBITDA perspective? And also, what version of the future have you put forward to potential buyers, right? And I would say the number one most common reason for deals that have been signed to ultimately fall away is softness in performance relative to the numbers that were put forward, either from a trailing EBITDA perspective or a forward EBITDA perspective. So I think, timing, but also what you have put down in terms of your budget or forecast is very, very important for that reason. So it's really hard, right? I always say to sellers, you have two jobs during this process, right? The first is running your business and ensuring it performs. And then the second is also going through a sell side process. And so it puts a lot of demands on your time. So that's reason number one. Reason number two, I would say, would be just some sort of either cultural or relationship misfit between the investor and the owner of the business, right? I think often pre-LOI, you don't necessarily get the chance to spend as much time together building the relationship, right? And I think it's really important. I'm personally a huge advocate to try to get to know the counterparty a little bit better before you actually put pen to paper, because I think that hasn't happened. If you haven't dated up front and then you're thinking about getting married, sometimes things can fall apart. So I do think it's important to, really verify and check that relationship will be healthy, because I always think about it from my lens as, hey, a lot of our job is handing folks, often a lot of money or a life-changing amount of money, and how will that relationship persist and continue to flourish after the fact, right? And so, yes, a lot of our evaluation is financial, but it's also about the relationship and how that will work post-close.
Nick Moritsugu, thank you so much for that insight. Josh Bilmes from Oceans Equity. Tell me about deal killers. We talked before about, looking at decks and coming to a determination. When you get a deal under LOI, what's the number one reason in your experience that it doesn't get to close?
Sure. So at Oceans, we tend to focus on lower middle market or smaller businesses. And the most common reason that post-LOI transaction won't close is a misrepresentation of the financial profile of the business. Not always intentionally. So I'm not implying that there's malice. It's just sometimes there's a lack of focus on building out the financial function of the firm, smaller business, and there's a lack of sophistication in that department, or perhaps it's just outsourced altogether. So it's hard to be close to the business in that example where you have an outsourced advisor. And so sometimes you just don't know what the earnings are or what perhaps is captured in the financials. And that is a big driver of determining valuation. So if you make a discovery in due diligence that says, hey, we thought maybe the business had this kind of earnings profile, but it actually doesn't, we're still interested. The fundamentals of the opportunity and you as a partner, all of these things are still intact, but we have to address valuation. If the expectation of the seller doesn't acknowledge that, hey, there are some underpinning assumptions by the time we get to an LOI that may change as we work through due diligence. And if there's too much rigidity there, then that can cause a deal to die.
And that happens during due diligence? Is that the most brittle time, or quality of earnings? Is that the most brittle time for a transaction?
At this end of the market, I would say so, right? Like I said, usually there's some more noise around the financials at this end of the market. And so getting through a quality of earnings. Now, if a business has already had that, prior to signing the LOI. In many ways, that can de-risk the transaction, right? You have a higher chance of success post LOI because you have the benefit of, more or less a third-party audit. Absent that, if that's work and risk that we take post LOI, that's where, sometimes you can discover things that you hadn't planned on.
Got it. Josh Bilmes, thank you very much. Casey Swercheck from Alterna. I want to talk about deal killers.
Yep.
So last time we talked a little bit about LOI and how many proprietary you get and how many you get from bankers. But
Sure.
once you've signed an LOI,
Yep.
what is the most common cause of a deal not getting to close?
Yeah, I think for us, given the size of the market where we focus, we tend to focus on smaller companies that from an EBITDA perspective are, 3 is kind of the low end of the range for a platform opportunity that we look at up to 15. Sweet spot's kind of in the 5 to 10 range, but more often than not, when you're investing in that end of the size spectrum, you're dealing directly with the founder. And so a lot of times what we find is founders tend to have a finance function within the business that maybe isn't always necessarily complete. They're still on a cash basis of accounting. We're going to help them switch to accrual, but long-winded way of saying sometimes the numbers aren't necessarily always where we start the conversation. When we get in and we always do a quality of earnings on every one of these deals. This is why I think it's critical whether you hire a banker or not, you at least have some sort of advisor that's helping you along the way to get ready for a sale process so that, you're not spending a lot of time taking your eye off the ball to work on a potential transaction and then not having the supporting evidence, financial documentation, contractual, whatever it is that's going to come out in the due diligence process that becomes a big red flag for us. So I think that's probably the biggest issue that we tend to see. Beyond that, we like to spend a lot of time with the founders up front trying to work through any of those big red flag areas that have tripped us up on deals in the past. And let's knock those out early and really focus on, how you get to the finish line in terms of the most efficient way possible by making sure you can get over any of those hurdles as quickly as possible.
Yeah, and I understand that all that's important. You want to get guys under LOI because of the investment that you guys will make.
That's correct.
That investment, probably most expensive investment is your time. But in terms of real dollars, give me just an idea or give our listeners an idea of how much you will typically spend during the due diligence, quality of earnings, and legal process to get a deal over the finish line?
Yeah, all the way through, I'd say on typical transactions, it's anywhere from $250,000, $300,000 on the low end to be upwards of, in our world, almost $1 million, depending on the size of the transaction. It really depends on the complexity of how many entities there are, what you need to consolidate, going into close, how those entities are owned. Is it an asset deal? Is it a stock purchase? But then it's also the complexities around the quality of earnings. All of those different entities, do they have to be reviewed separately? Has there ever been an audit done? Usually the answer is no. And so you're starting from scratch in a lot of cases, right? And I think that's part of the value at investing in our end of the size spectrum. Look, we're hoping to partner with founders, grow businesses to a bigger size, more diversification, more customers, more stability, and that imputes a much higher enterprise value multiple on the way out. And some of that is some of the cleanup work, frankly, that we're helping the founder do during the process of our not just the transaction, but our hold period.
Excellent. Casey Swercheck, thank you for your feedback.
Sure.
John Findlay from Periscope Capital. I want to talk about deal killers. Let's assume that we have a company that's under LOI. In your experience, what is the most common reason it doesn't get to close?
Yeah, I think it really starts with visibility into the business and how the business tracks during that period between LOI and closing against the targets that have been set for the business. And we frankly don't look at if a business were to not hit their targets, that's fine. We don't necessarily look at that as a negative, and we have a long history of appropriately addressing that with founders and sellers. But there has to be a middle ground there where if there's a material miss, it can impact obviously what was stated and represented in that LOI.
Meaning, I'm sorry, because that's really important. I'd like to dig in. So, meaning if the Q of E comes back or performance is not there during this 60 or 90 days, you guys aren't going to throw it in the trash. You're going to say, listen, this has shifted a little bit. The economics has shifted. Here's how we'll shift our structure of the transaction so we still both get what we want. Is that fair to say?
Yeah, I mean, I think we try to be fair and reasonable in that, where if, for example, bookings were pushed out and it's more of a timing issue, there's ways to bridge that, to your point. And we want to be really thoughtful in those kind of scenarios where if you have to add structure, it's a great outcome if it's achieved for everyone involved. That drives great alignment and incentive. But back to you talking about a QV, that is often where deals can hit a speed bump. And that's why I always encourage sellers to do sell-side QVs. Too often we'll see founders want to save the money on not doing those QVs. And it's at the end of the day, it's going to make you money. And so having that prepared for us to then do our own QV and setting that basis and credible data package really sets you up for success, I think, and enables the seller to really stand behind those numbers. I think that the second reason is just commercial performance, whether that's we spend a lot of time digging into the customer relationships, a lot of time understanding the tenure and the nature of those relationships, who's buying from you within those customers, and what is the ability to grow those customer relationships through the next 3 to 5 years. And so we spend a lot of time there. Sometimes, unfortunately, retention issues can come up during a process like that. Also, a lack of bookings momentum, net new account growth. And that can go sideways when someone sets too high of targets, whether it's bookings, whether it's pipeline growth, demand gen. I would encourage people to be very conservative with that target setting. You don't have to show exponential growth to get buyers excited. But it's important to set growth that is where you can provide that visibility through data that's going to be met or exceeded, and be able to show that beyond just the next 3 months. I think another thing that maybe some people wouldn't think about, but is team access, especially with really private, closely held businesses, sometimes family held businesses. There's a reticence to open up the access to the broader management team that frankly is, and more times than not, creating the value in the business. And we need to underwrite. We're a people first firm, and we really want to meet the entire team. And that's something that's really important to our IC. Really getting that access and seeing that alignment on what the value creation plan for over the next 3 to 5 years is going to be important. And if we don't get that access, that can be frustrating. And lastly, I think just during that final phase of due diligence, we really focus on the partnership. And, we know we have to get through our diligence work streams. We have to get through the legal motion. But what we really enjoy doing is sitting down with these entrepreneurs and their teams on debating and creating that dialogue around what that 3 to 5 year strategic plan is going to be, and having that healthy debate. And it's really important for us to see that that willingness to take our input and really understand that we have a track record over 13 plus years investing in this sector. So we can actually get that alignment so that when we close the deal, there's no question marks or surprises on what the value creation plan is going to be.
John Findlay from Periscope. Great insight. Thank you. Bill Dyer from Boathouse Capital. I want to talk about things that kill a deal. And I'm talking now, you've signed an LOI with a perspective and you're going through diligence and what have you. Are there a few common reasons why deals don't get to actual close?
Let me think about that. So yes, there are, I can give you the most common reasons that deals don't get to close, that, coming off the top of my head, number one would just be financial performance. We dig into the financials. Usually we dig into the financials quite a bit before we actually sign an LOI, but typically we're going to do our quality of earnings review after the LOI is signed. And it happens a lot that the reported financials are not the same as the financials once we really dig in. And the quality of earnings. Go ahead.
And Bill, so the guys are doing a fair, honest job with their financials. Why does it not match up to Q of E? What's the difference between the two?
So a Q of E is focused in less on a forensic review of the financials to determine if they are correct or incorrect, and more on a review of the steady state or the run rate of the business. And so, the Q of E is really teasing out one-time events. So a very easy one to understand would be lots of companies in 2020, 2021 reported really high earnings because they had a loan from the government, a PPP loan that was forgiven. So EBITDA wasn't 2, it was 4. And, we saw lots of companies, honestly, that came to market and didn't adjust that in the financials. And they're trying to sell their business off of 4 million of EBITDA and saying, hey guys, like, are you going to get a PP loan every year that's forgiven for $2 million? Like, if so, great, but otherwise that's really not germane to the business. So I don't think people, when people are reporting their financials, they're accurate perhaps, but they're not, they're inaccurate in so much as they may not speak to really the health of the business. Another one in a Q of E would be, hey, the company had a great 2023, but 2 months ago they lost, their 50% customer. In a Q of E, you're going to adjust the 2023 results for loss of said customer, and obviously the performance would be way, way, way down as a result. Yeah.
And so how do you think about, because usually from when you sign a letter of intent to close, you've got 60, maybe 90 days in there. And there's a lot of work that the entrepreneur has to do to provide you the rest of the material to get to close. How do you think about shifting financial performance during that period of time when you're going through due diligence? What if it's off by a little, and what if it's off by a lot?
Mm-hmm. So it's a good question. So if it's off by a little, look, there might be other information found in diligence which offsets for that little, let's say, where, EBITDA is off a little bit, but there's a bunch of new prospects, customers that are coming in the door, or, hey, we really just are excited about this deal and, we're willing to overlook the little bit. Or maybe, the deal is adjusted. Hey, seller, partner, entrepreneur, hey, we thought numbers were X, they're instead a little bit less than X, let's renegotiate the deal accordingly, and, deal gets done. If it's off by a lot, there's got to be a significant change to the deal, which happens, but often can blow deals up where, either the buyer or seller just say, hey, this isn't going to work for us. We certainly had situations where the performance was way off from what we expected, and it just, at that point, it's just the deal.
Yes, too big of a gap. Right.
Yeah, too small, whatever.
Bill Dyer, thanks for your input. Brian Schmidt from Court Square. I want to talk about deal killers. So all sellers or entrepreneurs worry that once we sign a deal with whoever the buyer is, that the deal won't get to close. From the buyer's perspective, what is the most common cause for a deal not getting to completion?
Yeah, great question, Todd. And I think you've had a good experience with us of getting to close more often than not. And part of that is obviously due to the work you do. But I want to start by saying our close rate, generally speaking, when we get to LOI is incredibly high, both as a firm for platform deals, but also for our portfolio companies that are completing M&A. And why is that? I think a couple different reasons, but first and foremost, we're typically building relationships with sellers and founders well ahead of a process to get a better sense of if that individual or group of individuals is someone we can partner with and vice versa, right? They have to have that mutual feeling about us. We prefer to also front load the value determining portion of our business diligence ahead of an LOI. What this allows us to do is stay true to our word on the LOI and then focus on the confirmatory work streams. So, accounting, legal, IT, HR benefits, that type of stuff after the LOI is executed. So that's what leads typically to us having a high conversion from LOI to close. With that said, the two most common reasons, Todd, that a deal falls apart between LOI and close are one, we're oftentimes not afforded the requisite access to complete our business diligence work, our value determining work ahead of the LOI. Some sellers and some bankers may try to obfuscate issues, right? That they candidly be better served by being transparent and earlier on and forthright earlier on.
And what's an example of that?
Yeah, look, I think it could be something like customer concentration. It could be churning a large customer. It could be the fact that the company's missing budget, right? There's a variety of things that we've seen. Then those are more typical, Todd. There's obviously some pretty unique circumstances we've seen in the past as well. But things that, look, I'd say private equity buyers, investors aren't dumb. They're going to get to the bottom of every issue. It's just a question of when. And so it's better for everyone to get kind of the key issues fleshed out up front and earlier on so that everyone is making a good use of their own time, right?
It's interesting because Ned McPherson from NROC, we just had a good portfolio add-on with Power Digital. And Ned was on the podcast and said, tell them everything up front because they're going to find everything. And it is a lot easier when you discover these things in conversation as opposed to hidden under a rock or hidden in a dark closet, and because then suspicions get raised, correct?
Absolutely.
That's great feedback. Yeah.
And the other thing I'd mention too, and this is pretty common as well, especially if you think about the marketing ad recession that we've been in over the past 18 plus months that we're hopefully, knock on wood, coming out of now. It's just a seller meaningfully underperforming their budget or projections in a process, right? So there's obviously a time between LOI and close, and the budget that is constructed presumably is something that has a real margin of safety in it, even relative to a normal budget in a non-sale year for a company. And so when we see companies start to miss budget woefully, oftentimes the budget's also back and weighted in nature. That sometimes is cause for, hey, no one wants to buy a business that isn't on the right growth trajectory and is on a meaningfully different one than even the management had conveyed at the start of the process.
Great insight, Brian. Schmidt from Court Square, thank you. Trenton Sisson from Mountain Gate Capital. Last time we talked about the deck and first impressions. From that, you move into an LOI. In your experience, as you move through an LOI, what causes those to not get all the way to close? And what advice would you give to avoid that outcome?
Yeah, absolutely. So what I would say first off is, really in our view, and I think what most people think of is the post LOI work is really meant to be confirmatory. And so what's so important is that the only thing in our view that kills deals between the pre-LOI and post-LOI stage is when we're doing that confirmatory work post-LOI and something doesn't line up with what we understood to be true perhaps pre-LOI, right?
And how often is that misalignment financial versus something else?
To be perfectly honest with us, we close the vast majority of deals that we sign an LOI on. So we Mountain Gate in particular try to do above and beyond. We try to be almost completely complete with business due diligence before we sign the LOI, because we don't want that to be we don't want anything to come up or have the opportunity to come up post LOI. I think where founders need to be cautious is if somebody is putting an LOI in front of you without doing a substantial amount of work or coming with a large degree of confidence about the industry and the space and having been through your financials in detail or asked you a bunch of technical questions about your product or service or, really gotten in the weeds, that's probably when you're high risk for a deal not closing post LOI, because sometimes people can use the LOI as, if you think about it from a buyer's perspective, usually you are spending money post LOI, but also you generally get exclusivity, which means that other buyers are generally going away and you're kind of the only, person that they're negotiating with. And so, if a buyer thinks that they like the asset but hasn't done all their homework, they might jump to an LOI very quickly to try to basically give themselves more option value to review it further. Whereas, we tend to be maybe slower and more methodical in terms of, hey, we don't want to get to signing an LOI until we're really sure about all these things, because it's so important that we have a good relationship and set the stage for kicking off the relationship in a really good way post-close.
And will you guys meet with somebody face-to-face before signing an LOI, or is a screen like this enough?
Look, depending on logistics, certainly we've done deals where pre-LOI has been entirely virtual meetings. So I don't think it's, culture is super important in terms of how we work with people. But I think nowadays with Zoom, you kind of have to be aware of how the world works, and people are generally very comfortable and have productive meetings via Zoom. And so I don't think it's mandatory that we meet in person pre-LOI. It's obviously preferred. There's something to your point about things changing pre and post LOI. There's something really nice about spending time with people in person. So we strongly prefer that. But we understand sometimes that isn't a possible.
Got it. Trenton Sisson from Mountain Gate. Thank you.
Awesome. Thanks, Todd.
Thanks for listening to the Second Bite podcast. We'll see you again next time, and be sure to click subscribe to get future episodes.